And the top story at this hour: for the fifth straight quarter, TCS has reported dollar revenues below street expectations. In the second quarter, growth stood at 3%. This was below the CNBC TV18 poll estimate of 3.6%, and that is just half of what Infosys managed in the second quarter. But volume growth and margins remain robust, and the company has also added more high-value clients. Reema Tendulkar has been analyzing all those numbers for us, and she is here right now with the analysis. Reema, take it away.
Well, it's a lackluster set of earnings from TCS. They have missed street expectations in the top line. The dollar revenue growth stands at 3%, lower than the 3.5% that the street was anticipating, and it's also lower than what they had clocked in the prior quarter. That said, the rupee revenues, margins and profits are in line with street expectations. Rupee revenue goes up by 5.8%. Margins expand by close to about 80 basis points to 27.1%, while the profits rise by 6%, and all these parameters are largely in line with expectations. On the top line, the company's constant currency growth stands at only 3.9%, so that's a bit disappointing. The street was hoping for a constant currency growth of 4.3, 4.4%, but volume growth looks fairly robust at 4.9%, and it marks a bit of an improvement compared to what they clocked in the prior quarter. With respect to margins, which have gone up by nearly 80 basis points, about 68 basis points is an account of Forex, and remaining 10 basis points is an account of operational efficiencies, but margins were expected to remain within the company's guided band of 26 to 28%. Some of the other internals are looking fairly healthy. So deal win stands at 13%. Utilization has been fairly steady, 86%. If you exclude the trainees, digital continues to be the key contributor to its growth. So digital has seen a growth of 10.7% in constant currency terms, and it now contributes 13.3% to its overall revenues, and client mining continues to remain fairly healthy. From the management commentary, they still seem pretty okay. They've indicated that out of the earlier identified 3 headwinds, for at least one of them, that's Latin America, they seem to be out of the woods. They believe that growth in Latin America will take place from here on, at least in constant currency terms. But for Diligenta as well as Japan, it will continue to be soft. So this quarter has not been that great for TCS. As we pointed out, there is a miss compared to consensus expectations, at least on the top line. But the question is, after the kind of underperformance TCS has already put in, how much of it is already priced in? Back to you.